Hey, what's up, bubs? Welcome to the Basic Concept. Today's topic, retirement accounts. In this video, I will be covering different types of accounts you can have, where to get started to have a tax-free retirement fund worth $1 million that produces close to $100,000 per year, tax-free. All from as little as $17 a day. Let's get right into the video. So retirement accounts are like your checking or savings account. Essentially, they're shell accounts that can do whatever you want in them in most cases. And most importantly, they don't guarantee success. Meaning just because you have a retirement account doesn't mean it's bringing any growth or income. You still have to manage it or pay someone else to manage it for you. Now luckily, most companies that offer retirement accounts will offer some type of a pre-made option for investing. Some companies will even allow some optimization or customization as well. For example, E-Trade starts with a risk assessment to gauge your style and then recommends funds based on how risky you want to be. You can buy stocks, bonds, index funds, mutual funds, pretty much whatever you want once you have this account established. Let's talk about different types of accounts you can have for retirement. I'll start with 401k since hopefully most of you should already know about this. Basically, it's an employment-based program that lets you contribute pre-tax dollars to your retirement fund. The maximum contribution for 2019 is $19,000. This is by far the easiest and most used retirement account because it's super easy to use. Your paycheck pretty much automatically deducts your desired percentage and contributes it to this account, especially if your employer matches anything that you contribute. Whether it's 1%, 3%, or 6%, that's free money for you. In other words, it doubles your money. So if you're contributing 3%, which a lot of the employers do match, you are doubling that money. In other words, you're costing yourself 3% of your salary if you do not participate in that program. Let's talk about some pros and cons for 401k. Let's start with some of the pros. It is going to be low risk because it's very diversified. It's going to be on autopilot, meaning you don't have to customize or optimize it if you don't want to. Employer match, which is essentially free money. It reduces your taxable income. You can withdraw or borrow against the money that you have. Let's talk about some of the cons. Because it's low risk, it is also low reward. As far as selection or customization of your investments, it's almost non-existent. When you retire and start withdrawing or taking income from the money, there are taxes at that point. If you withdraw partially or fully earlier than your retirement age, they do charge a penalty for doing so. Because most of these funds are actively managed, there are fees associated with that. Alright, let's talk about the Roth 401k. Now this is a relatively new option, and because of that, not every company has this available. If your employer does offer this, you're one of the lucky ones. Easiest way for me to explain Roth 401k is that this is exactly the same as a normal 401k, with the only difference being that instead of it being funded with pre-tax dollars, Roth 401k is funded with post-tax dollars. Why does this matter, you ask? Well, Roth 401k withdrawals are tax-free since you've already paid taxes on the money you funded it with. There's a lot of speculation that the tax rate is going to change. Rumor has it that tax rates are going to get higher, so this helps by paying the current, hence cheaper, tax rates. Secondly, and hopefully you get this account big enough where you are able to withdraw much higher income than your current salary. Your tax bracket would be higher regardless. So this does give you some peace of mind being tax-free no matter what. That covers employer-sponsored retirement accounts. Let's talk about IRA, or individual retirement accounts. There are several different types of IRAs. I will give a brief overview of traditional IRA, Roth IRA, SEP IRA, and Simple IRA. Before we break down each one of them, I do want to remind you that these can be in addition to your employer-sponsored retirement account. Let's start with the traditional IRA. This is very similar to 401k. Just like 401k, it's tax deductible, but the difference is going to be 401k does that automatically for you through your payroll company. This one, you have to deduct it manually or through a tax accountant. Another difference between IRA and a 401k is the amount of contribution you can make per year. IRA is capped at $6,000 per year as of 2019, compared to $19,000 for a 401k. Another difference would be the advantage of being able to choose or customize or optimize your investment options compared to 401k. And finally, similar to 401k program, this account is tax deferred until retirement. And now on to my favorite account type, which would be the Roth IRA. The reason I love this account so much is because it's funded with post-tax dollars, meaning that you cannot get a tax reduction at the end of the year, but your money grows tax deferred, and in retirement you can withdraw all of your money and not owe any taxes on it, period. Another reason I love the Roth IRA is that you can withdraw your contributions anytime without any penalties. Not that I would ever want to or need to, but in case of emergency, it's good to know that I have the option. The only downside or a con that I could think of for a Roth IRA account is some of the restrictions that it has on it. For example, you can only contribute $6,000 per year as of 2019. And if you're making more than $137,000 a year, you cannot have a Roth IRA account. Now, to both of these situations, there are ways around that. If you are in that situation, talk to your financial advisor or planner or call a brokerage for their advice. Before we get into what to do next, let me talk about self-employed people and business owners. SEP IRA will help you with that. SEP, or Simplified Employee Pension, is basically an IRA for self-employed people. Talk to your accountant or your tax professional regarding this one, mainly because depending on how many employees you have, you can also take advantage of Simple IRA, which is Savings Incentive Match Plan for employees. It's similar to 401k, but it's designed for smaller companies with 100 employees or less. Now that you know the basics of different retirement accounts and their pros and cons, what to do next. And as a reminder, this video is not financial advice, it's for entertainment purpose only. First, you gotta make sure that if your employer matches any of your contributions to 401k, that you are taking advantage of that. For example, if they're matching 3%, you should be putting at least 3% into that. Otherwise, you are giving back free money. Second, you gotta budget, and you gotta budget well. I'll link my video on budgeting right below in the description if you want to check it out. But you need to find $17 a day that you can contribute to your future. This would be in addition to your 401k. Third, you gotta open a Roth IRA account. There's no minimum for these, and the accounts are generally free as well. Once you have the account up and running, start funding it as soon as possible. Take the $17 a day, which ends up being $500 a month, or $6,000 a year, which, if you remember, is also the max for a Roth IRA account. Now, once the money is in your account, you don't have to buy right away. I personally wouldn't recommend buying per month. I would suggest maybe quarterly to keep the cost down if there is one. If there's no cost, then I guess it doesn't matter. And finally, invest and forget. You cannot want this to grow overnight. I suggest watching my investing mindset and compound interest video. I will link both of them in the description below, so you can gain a better understanding of what you want to accomplish with this account. This is not an account that you should be making daily, weekly, monthly, or even quarterly changes to. You gotta remember, this is for the end game. This is for the long-term goal, not the short term. You also have to know that this account will take time to get bigger. For example, if I estimate modestly with an 8% return, it will take 35 years for it to be $1 million account. Yes, that's a long time. But once you get there, you can withdraw a $97,000 salary per year, income tax free. Imagine that. A $17 a day investment can get you a $97,000 a year. And that's just with modest returns. S&P 500 has been averaging just under 10% for 90 years. Meaning that if you got 10% returns, you would get to the $1 million mark 5 years earlier at year 30 instead of year 35. The time to invest is now. Start investing today so you can live comfortably later. Let me know what you think of this video by hitting the like button or leaving me some comments in the comment section below. Your feedback is appreciated. You can also tell me what topic you would like to know more about. Additionally, if you want some free money, check out the affiliate links in the description below. Thank you for watching. We'll see you next time.